All right, good afternoon, folks. For those of you who are here, as always, if you have any questions about our markets, don't hesitate. Put them in the chat box. Let's get to it. Don't see many of us here at the moment, but maybe there'll be some more joining. Either way, your question is just as important as anybody else's. So you have anything you want me to answer to the best of my abilities, let me know. Nice recovery yesterday in the late afternoon. And today there was an attempt, but couldn't quite make it back into positive territory, at least on the S&P 500. So can you hear me? Dasboff? Is everybody able to hear me? Okay. Again, any questions, shoot them out there. Not many of us here. I know this is right after the market has closed. So, Rick, okay, gotcha. I should have known your handle. Oh, we'll stick around, see if any other folks join. Certain political thing go, yeah. Yeah, something about the former president. I faintly heard. I don't know. Yeah, I'm sure those in the northeastern corridor of the United States are probably glued to Fox News or CNN, depending on their political affiliate or affiliation. But I tend to disregard that, and yeah, it's more of a circus than anything to me. So, for those of you just joining, welcome to our live event. If you have any macro market questions, any questions on the economy, or even anything you want to assert about the economy or the markets, please feel free. Put it in the chat box. If you have a question, I'll get to it, answer it to the best of my ability. So are we stuck at 4,000 to 4,200 for some time? I wish I had that crystal ball to predict. But that's been kind of my, the breakout level that I had indicated in our weekly research report. Until we get above 4,200, all the breath thrusts in the world, all of the bullish feats of strength, all of the retest of the 200-day moving average, support at the 50-day moving average, curling up of the moving averages are just talking points. We are still in this range, that we've been in from the beginning of the year, because obviously all the gains that we initially had from January to February 2nd, I want to say it was, we gave up, in the first 2 weeks of March, and we gave up all the gains in the S&P 500. So realistically, we're stuck in a range from what is it? For round number sake, we'll call it 3,850 to 40, just about 4,200. So again, there's a lot of technical bullish feats of strength, obvious breath thrusts that have occurred this year. But until we make a higher low for the extended period going back to last year, all it is a trading range. It's something, recognizing the support levels and the resistance levels is important, because, without acknowledging them, you really can't trade in this range very confidently or in an educated fashion. We have to know what the moving averages are doing. We have to know where our support and resistance levels are to trade effectively within this environment. So definitely. That's my opinion. We're stuck until we're not. I would be leaning in favor of breaking above 4,200. And I say that because of the existing bullish feats of technical strength, as well as the breath thrusts that we've achieved here year to date. 4 breath thrusts, and the most recent one being the Zwig breath thrust. So those historically lend themselves to higher prices. Regardless of the macro, they, historically, if we're just talking about technicals and breadth, they lend themselves to higher prices. Typically, the assertion is, that the market is pricing in the fundamentals. Yeah. So we'll lead with that. Any other questions, please don't hesitate. Put them in the chat box, be them market or, macro fundamentals. Let me know. Let me know what you're thinking, what questions you might have. See what we got going on after hours here. If you guys will, again, minimal recovery here today, much better recovery yesterday. And quite frankly, if this is the consolidation that we're going to get where it seems difficult to go down. And, I think that's the message from yesterday into today. While we came into the week with, pretty significant overbought conditions on the McClellan oscillators, it's still difficult to get down. To put it frankly, this market is having difficulty going down. Today better than yesterday, but still you're finding buyers in the back half of the trading day. You're definitely finding more buyers than sellers in the final hour and a half of the trading day. We had a lot of buyers from 2:30 to the closing bell yesterday. And we had a mixed picture here today, but still we ended higher. In the 2:30 to closing bell, we were higher. Everybody's quiet. Nobody has questions. Come on, guys. Don't make me call you out. The mega cap tech have had a great move. What is your opinion of why they are moving? Safety rotation? Yes. Both, right? While the talking heads will profess that these will be just they hold on to these colloquialisms, which I refer to as straw man's arguments. Just reaching, grasping at straws, suggesting that the generals will be the last to fall. That's not how it works. There's literally no representation of that, in terms of market history. It's usually the small caps that are first to go. And they lead us out, except for COVID. So, if we're looking at, the most recent downturns in the market, the generals were the first to fall this go round. They took the biggest hits last year. They're mean reverting. They've done all the deleveraging, operational deleveraging, cutting workforce. All of those things help the bottom line results. That's why Meta got rewarded the way that it did. And to the extent Netflix doubled off of its lows, it's one of the reasons why it got rewarded. It also, operationally it improved. It has a more tiered, product lineup so far as subscriptions are concerned. Amazon, Google, right? They've gone through extended periods of consolidation, price deterioration. If we're suggesting that, the market is going to find lower lows when eventually, right, because that's what the talking heads profess, when eventually the mega cap 8, roll over, that doesn't seem in keeping with, the chronological order of events that have already taken place, which is the mega cap 8 already rolled over last year. They took it on the chin. Remember all the charts that were promoted in social media showing Meta down 70%, Netflix down 70%, Amazon down 60%, Google down 50%, Nvidia down 70%. Is it any surprise that these stocks are now up 60, 70, 80, 100% from their lows. But now they're supposed to roll over again. And after deleveraging, the balance sheet, deleveraging their operational expenses. Again, the things that people say versus, the reality of what's taking place in these companies, well, there's a mismatch, right? Um, I'm actually anticipating what has already taken place in Netflix, in Meta, in Nvidia, in Adobe. Adobe's another big one that has seen a substantial, bounce off the bottom. I'm anticipating something to that magnitude to happen with Amazon, Google, or one of them, if not both of them. How long is Amazon really going to consolidate, in and around the $100 level? I showed a chart just last week where it was at a pivotal point at $102 a share. It had been resistance and it had been support in the past. Well, lo and behold, I mean, we had selling pressure here today. Look what happened to Amazon. There are individual stocks that are sending messages. Amazon was an outperformer today. It closed, I think, 104 or better, above that 102 pivot point that I had posted in the chart on Twitter the other day. It's now 104. That's a break above resistance. That's a breakout. There's a message there. We've seen a message from the mega cap 8 for the last, I don't know, 3-4 months now. So yeah, I'm thinking there's more upside in at least a few of these names that include, Google and Amazon. And that's going to be supported, I believe, in their quarterly reports. I have more conviction on Amazon than I do Google. To be candid, I have more conviction there. Doesn't mean that I'm going to be right. That's just where my conviction lies. Full disclosure, I own Amazon. I don't own Google, although I've traded Google when it was below $90, as we have discussed in the Finom Group trading room periodically. So, to bottom line it, there is an air of defensive quality in the mega cap 8 because there's more earnings visibility out into the future and they're growth stocks, right? I mean, when the dust settles, growth is ultimately what you can rely on. And these are growth stocks. So they take on a defensive quality, a flight to safety, so to speak. It's rotation also. What underperformed last year is outperforming this year. So it's both safety and rotation for sure. Can you more fully explain how much percentage-wise you risk on each trade? 1% generally. If I feel more convicted in a trade, 1.25%, 1.5%. It's about conviction. It's about the trend. It's about recognizing, there's just so many facets of the market that I'm monitoring with our Finom Group members in the trading room throughout the day that we do discuss. So that should be secondhand to you, Sam. You should know what the answer to that question is. Just too many variables, that will vary, the percentage that I put forth on each trade. Average and median, though, is 1%. The average and median that I put forth on each trade is going to be about 1%. Questions, get them in the chat box, folks. Let me know. Checking future. Well, not futures. Futures don't open until 6 o'clock, but you can always tell, what futures might look like by the index ETF trading in the after hours, and pretty flat. So unfortunately, we had a nice streak going. S&P up 4 days in a row. The VIX down 7 days in a row. Both of those streaks ended today. And the last time we had something better, 8 days down in a row for the VIX, 5 days up in a row for the S&P was 2021. So it hasn't happened since 2021. I think that data or that quant stat from Urban Carmel on Twitter, good account there to follow. Do you have a time in mind when to be more cautious again? I know it's probably a few years. Yeah. When to be more cautious? Yeah, I mean, that's a good question. Trying to think of the best way I can answer that. With kind of a macro market feel, because I could never answer that for others. I can answer that for myself, right? Because I don't know everybody's risk tolerance and things of that sort. Um, but for myself, I would say, assuming the trend sustains itself through the Q2 period. And when I speak to the trend, I speak to this very broad trading range that we've been in for the year, right? We haven't dropped below 3,800 and we haven't risen above 4,200. Um, so I would say, assuming that we trend in this range through the Q2 period, I would suggest when we get closer to that debt ceiling deadline, right? I mean, from a macro perspective, that's probably going to be a good time. Not like the day before, right? But I would say at least the week before, you probably want to analyze your portfolio holdings, and see how you're doing year to date. Evaluate how you're doing year to date. Evaluate your cash position, and if you're comfortable in all regards, there's no real reason to get cautious. But if you're not, then there's probably uh, a good time frame there ahead of the debt ceiling deadline where you might reduce risk in some way, shape, or form. Again, what does that look like for each individual? I don't know. Maybe that looks like hedging for some people. Maybe that looks like taking down your long ARCs, exposure, ARC ETF exposure for some folks. I don't know, but just generally looking to see if one needs to de-risk their portfolio at least the week before the debt ceiling deadline becomes front and center. Like we actually are a week out from the deadline where they have to raise the debt limit ceiling. So, you know, from a macro perspective, I would say there. The other way to look at it from a market perspective is, like, if we do make a lower low this year, that would be problematic also. I think you would see, broad investor participation get that much more discouraged and start to deleverage. And it just becomes a self-fulfilling prophecy, that we exacerbate to the downside. It's rare that you have this kind of a broad trading range for, such a protracted period of time. Um, but based on that, if we make lower lows here this year, break the most recent low, which took place in the first day of the year, and then in mid March, you could get more cautious from a technical standpoint. So you've got your macro and your market technical cautious guidelines there, if you will. You always hear market doesn't bottom until after the last hike cuts starting. You don't expect that this time. That's actually not true at all. There's no truth to that. I've actually shown that data. The chart that gets passed around on social media via Bank of America, it's just wrong. It's wrong. The market has bottomed the same month of the last rate hike. The market has bottomed 1 month before the last rate hike. And the market has bottomed 3 years after the last rate hike in the past. That's why I say this notion, again, it's the Bank of America chart that is suggesting markets don't bottom until the last rate is just wrong. It's wrong if you actually look at the dates. We have all the rate hike history going back to 1970 that I published in an article at finomgroup.com. You can find it via my Twitter feed as well. But that's just, Again, I can't, when it comes to social media and these things that are said in the financial media, like on CNBC, like I can't correct them. I don't have a voice there, We have to actually legitimately do our due diligence and find out if there's truth to this or not. And the reality is that just not true. The most, I think, what most people have studied, because there's been so much correlation or symmetry and analogs pointing to 1982, right? Because that was the last time we had this kind of inflation and this kind of a Fed fight against inflation rate hiking cycle. The last rate hike that happened in 1982 was July. The market bottomed just before that last rate hike. So just from just an easy one to go check out. Hope that helps, David. Ricardo, how you doing, sir? What's your take on historic low levels of money supply and real liquidity? I'll try to figure out what you mean by real liquidity. Used by some analysts as harbinger of doom for confirming the recession outlook, and is this affecting your trade plans? Okay, so M2 money sock. I mean, that's what most people refer to when they refer to liquidity. Historically, and this is another chart that we had outlined in the past, is that the correlation between 4-quarter forward GDP and M2 has been more and more uncorrelated since the 1990s, right? It used to have a very tight correlation. M2, drains from the system and the economy slows. But there's been less and less need for real money stock, since the 1990s. So that kind of explains why the correlation has been, less effective or less correlated since the 1990s. And obviously the turn of the century, when you really just don't have the circulation of money that you did, prior to the turn of the century. So I know a lot of people point to it, as a harbinger of doom, as you say, but it would be more coincidental than correlatable nowadays. It would be more coincidental. Let's face it, we had the lowest money supply growth. We actually had money supply contraction last year. No recession, right? No recession. The notion that, oh, well, it's coming. Well, everything's coming eventually, right? That doesn't mean that it's correlated. Yeah. Wait, the sun's going to rise. That doesn't mean money stock has made the sun rise tomorrow, right? There's eventuality in most anything somebody wants to point to. It doesn't necessarily mean it's correlated. I think it was Larry Williams once. He had this fantastic chart that he put up. It was ice cream sales in the summer, right? Ice cream sales rise in the summer, and so do shark attacks. So that must mean higher ice cream sales cause shark attacks, right? And we know that that's just nonsense. We know the two have no correlation. It might really just be that there are more people in the water during the summer. It's not necessarily because there are more ice cream sales that we have more shark attacks. So, yeah, that's always something that I point to when it comes to recognizing correlation versus coincidence. All right. Good question though. In the grand scheme of things, when you think about liquidity though, just this is the other fact that gets kind of not misrepresented, but just outright, I guess, falsified, in social media. People always point to money supply follows the S&P 500 follows money supply, right? As if money supplies the primer, right? That's what drives things. That's the alpha dog, right? But that's not true. There's no liquidity. There's no increase with money supply without deflation. Deflation is all, or just inflation as a concept is the driver of money supply, i.e., the driver of liquidity. If a carton of eggs cost you $2 today, next month it costs you $1.75, you have disinflation. So now your dollar goes further. It doesn't necessarily mean you cut back on spending and boost your savings, right? Most of us don't do that. We take that extra 25 cents worth of savings, and what do? We throw that back into the economy someplace else. Hence, you have more liquidity. You have an increase in money supply. All predicated on the primer, inflation. Inflation's the driver. Always has been, always will be. The only thing that can supersede that, and which usually still happens in a disinflationary cycle, is if the Fed, pumps in artificial liquidity by way of quantitative easing, right? That would be artificial liquidity. So, Ricardo, I know that was long-winded, but hopefully it helps. Good question, sir. George, I think it's more important for me and most people to sit tight with positions rather than worrying too much. Do you really want to get cautious, de-risk, de-leverage, be a net seller because of one event that we know historically they have to raise the debt ceiling, right? So for maybe a couple of weeks, the market corrects. A week, maybe two, the market corrects. We saw what happened in 2011. Right after we finally raised the debt ceiling and we had our credit downgraded, it was up into, from the lower left to the upper right. How many people with what you saw in the headlines after deleveraging, after being net sellers because of the correction in the market at that time, were able and willing to, re-leverage, to become net buyers again? So to your point, George, absolutely, in my opinion, I think you're right. And that's usually what I do. I just ride it out. Let's face it, we're not going to go down 25% because of a debt ceiling debate that we know is going to get, raised at the end of it. After, we'll take it down to the wire, as we always do with these things, and then it gets raised. Right? So we're not going down 25% like we did last year. If you didn't deleverage last year and you just rode through the storm, kept your good holdings, and more than likely they're reverting to the upside now, you're no worse for wears. You take your drawdowns like big boys and girls. I mean, trying to, manage an exit and an entry, you got to make two really good decisions. That's very hard to do, right? I mean, that is a really tall order to ask of anybody, knowing what the headlines are going to look like. So good. Yeah, I agree with you there, George. Do you ever factor in demographics, which is the favorite for perma doomsters since time immemorial, it seems? I would say no. If I was being honest, no. I don't I know them. I mean, they're dancing around in the back of my mind. I know the demographics. I know they're beneficial. So I don't know why they're doomsayer. I get it for the labor force. I get that, right? It doesn't look good for the labor force, the demographics. But for the economy, it looks fantastic. You have, Gen Xers and Gen Z. Gen Xers right now are at their peak spending years. Gen Zers in the next 5 years are going to be at their peak spending years. We're in the sweet spot when it comes to consumer demographics. When it comes to labor force, that's a different story. But again, you also have to factor in, you have to weigh population demographics with, so an aging population, i.e., Japan, right? Because that's where everybody goes. Japan. We're going to wind up to being just like Japan. Japanification or whatever they call it. Japanification. Sorry. Right. We have to mirror the one example. The sample size of one is what we have to mimic. That seems far fetched to me. But you have to, weigh the aging population demographics with the information technology era. Do you really think one doesn't outweigh the other or at least exonerate the other? I would be of the opinion that the information technology era and the things that we see developing in technology, which limits the need, the demand for labor, offsets greatly and will only exacerbate over time. So I don't necessarily worry about the aging labor force, and I understand that there is a tailwind from consumer demographics, at least over the next 10 years. So good question. Good question. Seth, common sense in a storm. Yeah, I hope so. I hope so. Thank you. Any thoughts on nat gas? Good question. I know that's a hot button topic item. As I've said for some time now, you're going to see bottom fishers. You're going to see bottom fishers in nat gas. You're going to have this short squeeze in the energy patch. We've seen it elsewhere in crude oil recently, obviously, with the OPEC headline, the OPEC cuts over the weekend, proliferating in price action on Monday, a little bit here today. But what I've said with our Finom Group members is you don't want to mess around in this space. There's limited potential to benefit from some kind of squeeze in the whole of the energy space. And when everybody is thinking along the same lines of a short squeeze in nat gas and just a natural reflexive bounce in price, when everybody's thinking the same way, somebody's not thinking. Right? That boat is leaning very heavily in favor of everybody buying the dip. And so far, it really just has not worked from $4 down to $3 down to $2, right? And everybody's in the camp of, well, it'll inevitably bounce. Yeah. Well, if you're playing with futures, you're getting hammered. So it's not a space really that excites me. Futures participants in that gas, it's limited. It's a very illiquid market, no pun intended. But it's a very liquid market. It's stuff I stay away from. And that's not my expertise. So far as trading energy, so I stay away from it. And my working thesis is nobody's an expert in it. That's why it's so illiquid. It's so illiquid. You don't see too many millionaires and billionaires going on TV because they were energy futures traders. Like you could probably count them on one hand, the people that can lay claim to that. So a lot of folks will trade stuff that they see so much in the headlines. It's like gold, right? And my call was to see gold at 2000. Does it mean that I participated when it dropped down to the low 1800s recently to ride it up to 2000? No, because that's just not discipline. There's no discipline. You're not in it, as I've said before, you're not an investor if you buy gold. You're not. You're a capital preservationist. That's not my game. Neither is energy, so I don't play in those spaces. Nobody got rich, buying gold. And if they did, they would have gotten, they would have been wealthy buying the S&P 500. You're an investor buying the S&P 500. You're not an investor if you're buying gold. You're not really an investor if you're buying energy. There's just something wrong with your framework so far as investing is concerned. And I know that sounds like a heresy, right? Well, what about Miss Schneider, who's always in commodities? I never saw Miss Schneider's name on the top 10 of all-time traders. She knows her stuff in that space, but she didn't make any wealth, trading energy. Like that is don't get me wrong. Like the people that do that, man, golf clap. That is a tough way to make a living, trading futures. That is a tough way to make a living. The smart money makes it easy on themselves. They keep it simple. Buy the S&P 500. Wait, if we're not going down near 20% again, that would mean who cares about a downturn? Well, I've long since said that, and just know your levels, know your support resistance levels. And I'm not saying we can't, right? Because, we can't predict the future. We don't know if an exogenous event will come out of somewhere, a black swan, right? So there's always the probability. I just think it's on the lower end of the probability scale. To go down 20% in back-to-back years. What, one, two times maybe, in the last since 1950, maybe we've done that a couple times, right? I mean, talk about low end of the probability scale, right? And I know that's what the Mike Wilsons of the world, even Marco Kalanovich of JP Morgan is saying we're going to make lower lows. Savita Subramanian of Bank of America, we're going to make lower lows. Like, I get it. I hear all this stuff. But when we look at the data, we have to rationalize the probabilities. As an investor, you lean into the higher probabilities. Back-to-back years of 20% down, downturns in the market are the least of probability occurrences. Disciplined investors don't lean into the lesser probability. They just don't. If it happens, it happens. There's not much you can do about that. More than likely what you're going to hear if that happens is the headlines are going to start, printing once in a generation, opportunity, a generational buying opportunity. Again, everybody sees that coming, right? That's going to be the most highly anticipated back-to-back 20% downturn, year after year. Like everybody sees this coming, so it must happen. Is that really what you've understood from your investing experiences? What everybody sees coming happens. That's usually not the way it works, right? So again, we don't see recessionary conditions. Do we see economic slowing? Yeah, but that's natural. That's just part of the expansion cycle. That's how it works. Expansion cycles, as they get long in the tooth, GDP slows. If not for anything, just because you had a higher comparison in the previous year. But we've also never had household balance sheet and corporate balance sheets this strong, this robust. Jamie Dimon's annual letter to shareholders this morning spoke to that very, very fact. If a recession should happen upon us, it's likely to be short, shallow, and who's to say the market hadn't priced it in already last year? Something that we talked about in the trading room over the last couple of days is that what you will continuously hear from financial media and promoted on social media is that last year's downturn was a re-rating of the equity risk premium. It was pricing in Fed rate hikes, so on and so forth. The reality is that's what happens during recessionary forward pricing. But you don't get the full sentence because, people want to distinguish. They want to break these things apart as if they're not, as if they don't happen together. But typically you price a recession, which occurs in a manner that derates. You derate X amount of multiple points. The median derating is 7 multiple points for a recession. A recession bear market, the median going back to the 1960s is 7 multiple points. Well, what was our starting point in 2022? The S&P 500 was trading coming into 2022 at a 22 times forward PE multiple. What was the low multiple for 2022? 15.5, right? So 6.5 multiple point derating. Is it the market's fault that we didn't have a recession? No, because the Fed hiking usually leads to a recession. Just so happens time so far it hasn't. But we've done everything else when it comes to pricing a recession, right? Peak to trough on a closing basis, down 25% in the S&P 500. On an intraday basis, 28%. The typical recession repricing is down 34% historically, on average. Did we really need the extra 6%? Is that what's keeping people from saying the market hasn't bottomed because we didn't get the average 34%? Remember, that's the average. It's not every single time you drop 34%. That's my 2 cents. Okay. Let's see. Do you think there'll be any real change in regional bank lending, given all the discussion of fear of bankruptcies or change in laws that dampen lending? Yes and no. Time will tell. Those are kind of my squishy answers. I think we'll get some form of regulation, but legislators aren't, ignorant of the fact that we need an economy to grow. They're just as incentivized to create legislation that promotes growth rather than restrict growth. Everybody speaks to, additional legislation and regulation as if it's just done with an undiscerning hand, just a wave of a wand, and we have restrictive policies. That is not the way it works. It makes good, for financial media programming, but rarely is that what you see play out in the economy, in any space. I mean, we've had greater rules and regulations in the banking, in the financial industry post the great financial crisis. What happened after that? Oh my gosh. Well, we had the longest expansion cycle in history. So that's the way I look at it. Don't assume, I wouldn't assume that more regulation, more legislation is automatically restrictive policy. Maybe I'm just being too optimistic. Who knows? All right, let's see. A 10-year bond has gone from 407 to correct. What are bonds saying to Powell? In my opinion, they're sending a clear signal, that you guys are done. I think the FOMC as a whole has already conceded to that point by removing the language ongoing rate hikes are necessary or will be necessary, right? So to some degree, they've already conceded to the bond market. We'll see if there's follow through. Of course, they're still data dependent, which they should be. And as investors, we should anticipate, or we should give flexibility. We should understand that nothing is cemented when it comes to Fed policy. If you're data dependent, nothing is set in concrete. Removing that language of ongoing rate hikes will be necessary gives the Fed greater flexibility. They can still raise, or they can pause, look around, weigh the incoming data over the next several months before they do anything. It gives them greater flexibility. JP Morgan's Matthew Boss raised Macy. Yeah, I know. I saw that the other day. We love it. We love it. I love when analysts make terrible calls, right? I mean, he's been at 28 for a while. Has that been the right call? Obviously not. So let's up the stakes. And this comes on the heels of Macy's presenting at the JP Morgan conference last Friday. So they must have liked something that they heard. I don't care. I've gone up against these analysts on Macy's. I've gone against Jim Cramer on Bed Bath and Beyond. Ricardo, you don't go up against me when it comes to the retail space. That's not a good way. That's not, you can't make a good career out of that. Going against me in the retail space. So I'm happy about it. I'm happy about it because I believe it gives us the opportunity to continue shorting shares. We've had already, we had one short this week. We've been shorting it in previous weeks from $24. It most recently got under 16. It's bounced, got under 17, and it has bounced. It had a nice, day the other day. We're trying to, we had a trade alert out there today to try and short it over $19. We had it at 19.33. It never got there. But our game plan suggests that we would be shorting 19s, possibly 21s, through the graciousness of the market, hopefully 23s and 24s. I don't think that this has that kind of fundamental backing. The metrics in Macy's are awful. The CEO stepping down. They're going to announce, I believe, by the end of the year, more store closures because shopping habits are normalizing. Last year, 2022, consumers wanted to get out again. They felt more comfortable getting out again. So you had some kind of beneficial flow to brick and mortars, the actual physical store locations. But a year of that, we're already seeing the reversion back to e-commerce. You can see it in the monthly Census Bureau retail sales, right? Department store retail sales going down again year over year and month over month. What's happening? What do we see happening in non-store retail sales? It was like the bright spot in last month's Census Bureau retail sales report. Like it's reverting already. And, prior to COVID, or prior to 2022's get out and about again, you had 12 years of the siphoning of retail sales from brick and mortar to e-commerce. It's picking up again. It's just picking up where it left off. Last year was just kind of this give back year where the consumer felt comfortable. We were beyond the Omicron. Once we got beyond Omicron, everybody felt comfortable. They felt a genuine need to be out and about. A year of that has passed, and it's reverting right back to the dominating trend over the last decade plus of e-commerce. And that it has been painful for Macy's. And let's not forget, Macy's is in my bankruptcy chain. It's just a matter of when they get there. Oh, I know retail's not dead, but don't worry about it. I don't care if retail's dead. It's dying. Brick and mortar is dying. It's the dying part that hurts investors. Death doesn't. It's over. JCPenney, it's over. The Sports Authority, it's over. Toys R Us back in the day, it's over. The death is actually the relief. The dying part of retail is what hurts investors. Bed Bath and Beyond, it's still not dead, but the dying part is still hurting investors. Went into my Truist branch today in St. Augustine. An area manager said employee stock purchase was through the roof. Okay. I mean, the insiders, right? When it comes to what's happening in the bank sector, and this is the other thing that doesn't get spoken to very much when it comes to financial media, right? The regional banking sector has dropped 25% through the month of March, right? And everybody's worried about the impact, when they start to report. The banks start to report April 14th with JP Morgan, Wells Fargo, Bank of America. As if I had that on the tip of my tongue, right? Trust me, I know my schedule, folks. Right? So what's going to happen when the regional banks report and things are... The market's a forward discounting mechanism. You think that the regional bank sector dropped 25% for the fun of it? It's already priced in what is expecting in the future, which is worse results out of the banking sector. However, more importantly, to your question, Triple M, the insiders, when you look at the insiders for the financial sector, they are buying hand over fist. When did we last see this? When you had a big turn down in a particular sector of the stock market, we saw this last year. We saw it with the Nasdaq and we saw it with technology. Insiders were buying hand over fist. What's working this? Insiders can be early, but they are rarely wrong over a 6 and 12-month period. They are rarely wrong. So good comment. Thank you, Triple M. Let's see. Seth, do you ever use CO? I'm not familiar. Oh, COT. Yeah, I look at it. Yeah, I don't. When I think it's interesting, when I think it's necessary, I should say, I'll look at this. The commitment of traders report. There's little utility in from an investor standpoint. There's very little utility there. From a trader standpoint, there may be some incremental benefit, practicality to it. But from an investor standpoint, the COT report is not going to sway me from buying or selling Amazon, from buying or selling Apple, from buying or when I make long-term buying decisions, I don't care what other people are doing. I care about the fundamentals of the company. So if I was to, give you kind of just a broad answer, I'd say investors, actually, that would prove noisy. From a trader standpoint, there's some incremental practicality to it. Trying to interject it into a game plan, the COT data, based on net shorts versus net longs. Is it commercials or non-commercial? That are more heavily weighted short or long. It's not my favorite. It doesn't determine much, I don't think so. What else can I kind of say? And you may have seen me post this from time to time, the COT, looking at net shorts and net longs, because sometimes you can see squeezes happening, if the boat is leaning too far in one direction. That's largely what happened in the beginning of this year, right? I mean, the net future short position from the non-commercials, i.e. the hedge funds, was pretty heavy. Most of the first part of this year's benefit to the upside in the markets was short covering, and you can kind of assess that through the on balance volume indicator for the S&P 500. Generally, when you have this kind of a rise, up 7, 8, 9% in the S&P 500, up to the February peak, the on balance volume is rising in tandem. It did not. It did not this go around, which also made the rally circumspect, because it wasn't true buying. It was a lot of short covering. Most new bull markets, when you see that kind of rise that we did in the S&P 500, you can recognize it being new bull market behavior, because the on balance volume indicator is rising with the S&P 500. This time it didn't. And lo and behold, look what happened. We gave up every bit of that gain. We got to unchanged on the year by, what was it, mid-March. So, however, and just to kind of update, we did see, at the last 2 weeks of, the rally that took us back above 4,100, we saw the on balance indicator hit a new high for this year, a new year-to-date high, which told us that indeed those final 2 weeks of the year, taking us into the end of the quarter, that was true buying, folks. And it was likely chased for performance. Those who were underweight, underleveraged the market, didn't own the FanMag names, and what worked in the first quarter was FanMag. If you don't show that you own that to your clients, at the end of the quarter when they get their statements, they're going to wonder, what the hell are you doing? So you had chase for performance there. Okay, and we got to wrap this up in a few minutes, folks. So please, if you have additional questions, get them in the chat box. I'll go if I see the chat, the questions in there. Let's see, COT debt. What do you think about office real estate in the face of? I'm not familiar with WFH. Forgive me, but if you're talking about commercial real estate, again. I think there's just ton of noise. Everybody, right? Home prices, residential real estate was supposed to dive double digits, right? Supposed to fall double digits this year. Do you realize that the what is it, the real estate, the I forget the acronym for it, but now they're actually projecting a rebound in home prices this year. After the first quarter, all of a sudden we're expecting, we're projecting, we're forecasting. The Real Estate Association is forecasting a rebound in residential real estate prices. So, if we're talking about, commercial real estate, when do people underreact? Right? When do most people underreact to headlines? I think, if you're worried about commercial real estate, you're probably feeding too much of your attention to the headlines. So far as work from home, so I guess you're okay, work from home. How do I feel about that? Um, I think that's a that has legs. That has survivability, George. I think that has survivability. I think that trend will only exacerbate for as we, go through history. Um, it's just on it's on par with technology. It's on par with technology. If you believe in the information technology having legs, then you believe that work from home has legs. Prime example, my wife was a public school and private school teacher for 18 years. She left, teaching, and she now works from home for a company that is based in Oregon, big city in Oregon. Anybody in the chat? What's the big city in? Portland, Oregon. It's a curriculum company. They do the vocabulary online, with online software for all the schools around the world, around the nation. So she works from home after 18 years, right? So she handles the southeast coast of the United States. That's her territory. So for the teachers and whatnot that are using the software, that are using the program in their schools, they have questions, they have problems. Sometimes she has to travel to the school. She has the whole East Coast here. But most of it she can handle online through, calls and meetings, not Skype, Zoom conferences and things like that. So information technology is just, well, I should say work from home is a byproduct of the information technology era. And, I don't see it abating. I don't see it abating. What would you say is the biggest difference between trading markets during regular trading hours versus trading futures? The biggest difference is liquidity. Number one. And quite frankly, nothing else matters. Nothing else matters but liquidity. And you just don't have the liquidity in futures. You don't have it. In fact, it's not that you just don't have liquidity in futures. You have persistently less liquidity year after year after year. And that's basically been since 2016. In 2016, we've seen the number of futures contracts within $1 of the strike lower and lower and lower every single year. Why? If the question was why, I could give you a host of reasons. Not that, but it doesn't matter. The fact that you have less and less liquidity it's a problem. It's a problem. So, trading futures is a tough business to be in. It's a tough business to be in. What I often say, to people who are trading futures initially successfully is say thank you to the market and move on. Because there's an inevitability there with futures. There's an inevitability there. And it's not a good inevitability. So, broad strokes. Tech rally to continue or flatten out a bit in Q2. Again, no crystal ball. Again, I don't care. I think about it long term. I think, if it flattens out, I'm probably getting better prices, right? So I'm getting value. Do I believe in Apple long term? Do I believe in Microsoft long term? Do I believe in Adobe long term? Do I believe in the tech sector ETF long term so I don't have to be a stock picker and just make it simple on myself? Yes. So if the market wants to flatten out, if it wants to even contract, maybe give us a 10% correction in tech or the NASDAQ, right? Tech heavy, growth heavy NASDAQ, I'm okay with that. To the same degree, I was okay with a 34% drop in the NASDAQ last year, which I was just dollar cost averaging my TQQQ position. So I'm not looking to time it. I've got plenty, the way I would suggest people think about, the probabilities of consolidation, right? Consolidating in price for anything that you believe in, that you have conviction around, is hope for it, right? Because if you got conviction and cash, that's called opportunity. And when the two meet, that conviction and that cash, that opportunity come together, good things happen usually, right? And that's not to say that everybody, is going to pick the right sector and have the right conviction, for the right area of the market. But as I always say, make it simple on yourself, folks. Look at the last 10 years. What has outperformed? A lot of people will feed into the narratives that they find on social media, right? Well, we're going to go through this commodities boom cycle. But do you know what the context around that is, right? Do you know what the context is? When was the last commodities boom cycle? How long is a boom cycle? Folks, you get maybe 12 months. What did we just have? We had a 12-month, boom cycle in commodities. It busted, though, in a glorious way. Look at wheat. Look at sugar. Look at cotton. Look at the agricultural commodity complex. Look what happened to it. It didn't even last 12 months. Stocks. Like, don't get wrapped up in the stuff that financial media promotes. It often is just they're doing it with gold now. Again, go back 10, put up the gold chart compared to the S&P 500 going back to 2009. The S&P 500 is up, what, 450, 460%? Gold is up 95%. What are we talking about here? That's the difference between the big picture and what financial media is focused on day in and day out. It's just the hot button topic of the day. Don't let the hot button topic of the day interfere with your long-term strategy, your long-term goals and objectives as an investor. Financial media can be the upending of many unsuspecting, novice, even intermediate investors. Just don't let it happen to you. All right, I got to wrap it up, folks. Thank you for, tuning in. Appreciate all the questions. You know where to reach me at finomgroup.com. If you're not a member, join. We got a great group of traders and investors, great strategies, great research. You know the deal. See you next time. We'll probably want to do another one of these on Thursday. I know that the market's closed on Friday, so we might do another one of these live events on Thursday. So stay tuned to my Twitter feed, or you can always subscribe to the free YouTube channel for Finom Group. Take care, everybody.